I never thought growing up about this concept called collateral damage until I got fired from my job, where really in a lot of ways I was collateral damage. But everything changed. I mean, everything. There were people that worked for me at the time. Their lives changed. They were collateral damage. There were bills that I had to pay. The people that were going to get that money that I was no longer receiving, they were collateral damage. There's all these dominoes that happen because of this one event. I realized then that there's always this whole second sequence of events that happens whenever events occurs. I mean, you always hear about the big ones, right? Like war, disease, car pileups, things happen. But even during market downturns. Live from the 3-room apartment above Uncle Jack's garage while we get ready to move to Detroit. Welcome to another episode of Money in the Morning. Hey there, stackers. I'm Joe Saul-Sehy, Average Joe Money on Twitter. And on today's episode, scintillating stuff about the stock market. We're going to talk about Nikki Haley resigning. We're going to do that without talking politics, too. How great is that? All that. And then at the end of the show, we're going to take these two desperate topics and tie them together into something we call the big idea. Money in the Morning is brought to you by Tiller today. Tiller, by the way, won FinTech Breakthrough Awards 2018. They won Best Wealth Management Tool. You know why? Because whether you want it easy like I do when it comes to tracking your money, or you're like mom and you like your spreadsheets deluxe edition, Tiller's got it all for you. Head to stackingbenjamins.com/Tiller, Tiller, for more. Check it out for yourself. We're going to talk more about Tiller a little later in the show, but go check it out. They're winning awards, people. Speaking of winning awards, we're not going to win any awards for podcast openings unless we get to the real stuff, right? So let's get this party started. Laura?
Here are today's Money in the Morning headlines.
We do this podcast in front of a live Facebook audience, and they are rowdy today. John is in the audience and says, was that desperate topics or disparate topics? Why does that have to be either or? Can't it be both? Both desperate and desperate. Yeah, I'm trying to use big words here to prove that, I don't know what I'm trying to prove. I'm trying to prove that I can get on with the show. So let's go to the first headline, which comes to us from MarketWatch. I found this interesting. Jacob Passy writes this. More of an opinion and advisory piece. He writes, does stock market volatility make CDs tempting? Read this first. Jacob writes, certificates of deposit might be thought of simply as a safe haven for cash, but they can pack a punch in the right circumstances. Since 1967, certificates of deposits have outperformed the stock market about 30% of the time on the basis of a one-year return period, said Brian Krimzad, co-founder and senior vice president of research at Magnify Money, citing an upcoming research report from the Personal Finance website. The longest period when that occurred was in the early 2000s after the dot-com bubble burst. That lesson might be of some comfort to investors right now. The Dow Jones Industrial Average shed 831 points last Wednesday amid the worst sell-off since the market correction that took place back in February. On Thursday, stocks continued their descent, prompting concerns of another correction. Rate of return notwithstanding, CDs carry another benefit that can make them more attractive than bonds. The deposits are FDIC insured. You can't lose money you initially put into a CD, even if you withdraw early. Whereas when selling a bond before it matures, an investor does run the risk of losing some of their principal, depending on the market's conditions at the time, Krimzad said. Meanwhile, rates on CDs have benefited from the Federal Reserve's interest rate hikes over the past year, making them a more attractive tool for consumers seeking a safe haven for their money. But that doesn't mean people should necessarily jump on the CD train just yet. Quote, the lesson isn't to go and put all your money in CDs when the stock market declines, Krimzad said. It shows that you need to have a balanced portfolio. In short-term CDs, In the short term, CDs can be advantageous. I love doing this live, but they are no replacement for long-term stock market investments. Pulling money out of stocks now would only seal losses in, and funds earmarked for long-term goals such as retirement are still better off in stocks. If anything, investors can get a bargain by putting money in the market now. Quote, putting new cash into a CD in response to short-term market volatility is a little bit like yelling, look out to somebody right after they've been run over by a truck, said Ben Birkin, advisor with Woodward Financial Advisors in Chapel Hill, North Carolina. You look to reduce risk right before things get bad, not after. But when the dust settles in the sell-off, consumers should turn their focus back to CDs, depending on what their investing goals are. Many online and community banks and credit unions are now offering 12-month CDs with rates at or above 2.5%. By the way, when we go to Magnify Money as part of our other podcast, Stacking Benjamins, you know what we find? We find that CDs just a little bit above money markets or high interest savings accounts. High interest savings accounts now, the top one's paying around 2.5% as we record this. We've got 7 or 8 at Magnify Money that are sitting above 2%. So, and that number's increasing all the time. Very, very interesting. Let's talk about CDs, because it's funny. People do things like this to avoid stock market risk in times like now. And I think to myself, is this really the right time to be doing that? It seems to me that this is a great time when the market gets volatile. If you're still in saving mode and your goal's a long ways away, this is the time to be saving into those investments like the stock market. Like, let's put more money in. I'm not looking to get out yet. So if I'm not looking to withdraw my money for good, I should be putting more in. I should be looking at ways I can save more money. Saving more money is the thing we can control. We can also control when we take the money out. The bumpiness of the ride along the way, the longer the flight, the more times you're going to experience turbulence. CDs are great when you don't want turbulence. We often worry about stock market risk, but there's other risks that we have to worry about too. Risk comes in a lot of different flavors. So you worry about stock market risk, you move to CDs. What do CDs suffer from? Interest rate risk. You're going to move from something that historically has gotten 8 to 10% in the stock market over long periods of time to something that's at 2.5%. Maybe in better times, I've seen CDs do 5, 6, sometimes 7. But you're not going to get the same return that you will in the stock market over much, much longer periods. So I worry about that. In bonds, if you look at the bond market, people pull out of the stock market and go to bonds. We have interest rates going up right now. When interest rates go up, the value of your bonds fall. So I worry about bonds also. Worry about different types of risk. There's many different types of risk. Worry about all the different types of risk. Don't just ask about the risk of one investment. When you hop into the new one, say, what risk do I have in treasuries? What risk do I have in CDs? CDs don't seem risky, except for the fact that they pay 2.5%. And today, as we record this, in the last 48 hours, Social Security announced that next year they're going to raise Social Security payments to recipients by 2.8%. So you're going to earn 2.5 on your CD, and inflation, which is measured when they give out the Social Security benefits, is 2.8. By the way, inflation's higher than that, right? Because when the government looks at inflation, they take away a lot of the pieces that actually make up true inflation. So true inflation much higher than what CDs are paying. You're actually going to have to save more than dollar for dollar if you use CDs. Big risk there. Love that. Let's say hi to our friends hanging out on Facebook. We got a bunch of people here today. Kurt is here. Hey, Kurt. We've got John here. We got 2 Johns here. John, who's in Seattle normally and in Minnesota today. And then we have John number 2. And I'm not sure where John is. John hangs out with us quite a bit. He actually says, doesn't the stock market trend up 70% of the time? Depending on the time frame, yes. So if you look at stocks getting beaten by CDs 30% of the time, you can kind of do that Do that math. Jason's here. Hey, Jason from Rise Against Hunger. Fantastic time with Jason when we were in Orlando. John is here. Kimberly's here. She was here for the sound check. She's probably gone now. And then our friend Karen is also here. But John says the risk of missing out on all the gains. You're saying we should all embrace the fear of missing out. Yes, we should all jump on the fear missing out train. Everything. And if you didn't do that with Bitcoin in January, I mean, look at all those people in January that jumped into Bitcoin. Aren't they ecstatic today? Just jumping up and down. You know, we talk about putting more in. Bitcoin might be the exception to that, because you really, with the stock market, you know, it's based on the economy. With Bitcoin, it's based on adoption rate. There's so many different factors when it comes to that. Eric's here. Hey, Eric. Eric says CDs seem risky right now because you might not keep up with inflation. Amen, brother. John is in Kansas. Our other John, it's a John fest today. We got 3 different Johns. The other John is in Oklahoma. Let's move on and talk about this second headline. I found incredibly compelling, which was, we've heard, if you follow politics, you know that Nikki Haley, the ambassador to the United Nations, is resigning. And I saw this piece in Money that says Nikki Haley's resignation puts a spotlight on her debt. Here's what we know about her money. I don't want to talk politics here. I want to talk about somebody and their job, and the fact that their debt, not their job performance, is the headline. This is going to be fun. This piece written by Jennifer Kalfas. When Nikki Haley announced she would resign as U.S. ambassador to the United Nations at the end of the year, rumors swirled around her potential 2020 ambitions and next move out of President Trump's administration. But her decision to resign also puts a spotlight on her personal finances, particularly the hundreds of thousands of dollars of debt she's accrued over the years. Haley's 2018 financial disclosure form showed various forms of debt, including between $25,000 and $65,000 in credit card debt, and both a line of credit and a mortgage worth between $250,000 and $500,000 separately. Nikki Haley's debt, therefore, could range anywhere from $525,000 to $1.1 million. On top of that, Haley's financial disclosure form showed a mortgage worth at least $1 million on an investment property she took on from her parents in 2017. However, she and her husband, Michael Haley, reportedly sold the property for $1.2 million back in January, according to the State, a Columbia, South Carolina-based newspaper. In her resignation letter to the president, Haley wrote she plans to enter the private sector, which will likely prove more lucrative than the reported $180,000 she makes in her current government role. In a statement to the Post and Courier, Haley's office said her finances had no role in her decision to resign from her post and insisted the U.S. ambassador's debt is less than $500,000. Representatives for Haley did not respond immediately to a request for comment from Money. Haley reported she owes anywhere between $15,000 and $50,000 on a Bank of America card with a 12% annual percentage rate, as well as anywhere between 10 and 15 on American Express card with a 12% annual percentage rate. Both of these debts were incurred in 2016, according to the form. Haley's initial total monthly payment on those cards could land anywhere between $500 and $1,300 a month, according to Matt Schultz, chief industry analyst at Compare Cards. We just, by the way, have Matt on our FinCon episode where we interviewed a lot of people there. Matt is a super intelligent guy. That, by the way, was Joe's commentary on this piece. Those ranges will go down each month if no new charges are made, explains Ted Rossman, an industry analyst at creditcards.com. And luckily for Haley, her interest rates are lower than the national average of 17.07%, Rossman says. It's important to look at Haley's finances with a bit more context. She's reported far more than the average credit card balance for Americans these days, around $6,354, according to 2017 figures from Experian, a credit reporting company. But especially for wealthy Americans, Card balances don't necessarily equal long-term or even short-term debt, Schultz of Compare Cards says. High-income Americans could spend large amounts on their credit cards and pay them off at the end of the month to earn rewards, or they can leverage their debt to help them with investment opportunities, said Schultz. Quote, that interest accrued on a revolving balance can be a big deal for the average American who's living on a budget and paycheck to paycheck, says Schultz. For wealthier Americans, it might amount to a rounding error. It's all about perspective. They go on about Haley's income, and I'll link to this on my Twitter feed, Average Joe Money. It's so interesting to me that when it comes to Nikki Haley's job and what job she takes, there's this collateral damage issue of her debt. Maybe it is and maybe it isn't. Like we said, it could be a rounding error, could be anything. But I do want to talk about you in this context because this is a great introduction into how your debt factors into decision makings. We don't know if Nikki Haley's debt has anything to do with her going into the private sector. We do know that the private sector pays much better than a government job, right? Government job's a great place to be from. Then everybody wants you. You earn a bunch of money afterward. I'm sure Nikki Haley is definitely going to be a wanted commodity in the private sector. And she's going to make a lot more money if she's smart. And I think she is smart. Probably going to make a lot more money in the private sector than she did in the public sector. And if that's the case and she has debt, this could be a way to attack that debt. And it's funny how debt, not funny, haha, but funny, interesting, that debt fuels your future decisions. I mean, debt's this chain that somebody else can pull whenever they want. And if Haley's hearing from her creditors, unless they can get away from her, your creditors come calling, the amount of income and where you get that income from can make decisions for you that you might not want to make. Once again, getting away from Nikki Haley. Let's go to my personal life. I remember I was starting to make some long-term decisions with my career, and I couldn't make them as fast as I wanted to for one reason, because I had too much debt. And I had to make short-term decisions about how I get this stuff paid over the short term. And it was for fun I already had, people I already owed money to, stuff I'd already done. I couldn't look at the future because I was still a prisoner of the past. Very frustrating, by the way, incredibly frustrating. I got all these ideas in my head, all this stuff I want to do, and I have to make short-term, short money focused decisions because of mistakes I've made before. You don't want to get into that situation. So I think whether Haley's moving to the private sector for opportunity or to pay off our debt's kind of irrelevant. What is relevant is where are you with your debt and how do we come up with a strategy? And I think it's funny, by the way, this guy, Ted Rossman, talks about how Nikki Haley is lucky because her debt's only at 12% versus 17%. If I told you that there was an investment out there that was a guaranteed 12% interest rate, what would you say? Like, oh my God, I'm all over it. Like, who pays 12% guaranteed? You do. If you have credit card debt, you're a guarantee. And they say that she's lucky that she pays that little. So you're high-fiving yourself, hey, I'm only paying 12. If you get 12, you're on a completely different boat. You're like, I think that sounds too good to be true. You are too good to be true for the credit card industry. But on the other end, they don't like you because they only get 12% versus 17%. Think of your finances as if you're a business, and I think you make decisions a lot differently. Good stuff there. Let's say hi one more time to our friends hanging out with us on Facebook today. We got quite a few people. Says Ronaldo says her debt isn't bad relative to her income. Not making a ton of money yet. They say she makes $185,000. Don't get me wrong. That's good money. But based on her potential debt level that she has here, Ronald, she still has a fairly decent sum of debt. And that credit card debt, if it is a balance that she's carrying all along, that still is a lot of money she's paying out. Gregory says, for the truly nerdy, the financial disclosure forms that senior members of any administration can really be interesting reading. They're kind of a view into how some really, really rich people invest. I think that's Yeah. I've only read a couple, but you're right. Very interesting. A lot of private placement investments. I see a lot of investing in private companies, and which shows again a lot of investing for truly wealthy people is who you know. Ronald says she could also use a home equity line of credit, absorb the debt, and make it look like there's no issue. She does have a home equity line of credit, according to this piece. She's a home equity line of credit. She has a mortgage. She also has revolving credit card debt. All three of those. Gregory says, being the governor of South Carolina does seem like a pretty solid plan for attacking my consumer debt. Yeah, once you are in public office, cashing in privately is a nice place to be. Kurt weighs in. Debt's a good shackle attached to your neck, he says. Amen. Man, it was for me. It was absolutely horrible. Shireen or Paul says, more money, less aggravation. Sounds like a win for her. I think going to the private sector if she's doing this to pay off debt, I think it's a huge win. I think it's about time. I think it's going to be difficult if this debt is a weight around her shoulder and she feels like that to do, the big political stuff. If she's worried about money, you can't be worried about it. So, Kyle says, I think her debt's odd given her income. Yeah, there's going to be a lot. There's going to be a lot of money around the corner for her, though, Kyle. I think that's going to be interesting. And John weighs in, says she can get pardoned, right? Now we're going into politics, and we're going to leave it right there. Hey, in just a second, I want to tie these two together, these two pieces that seem to have nothing to do with each other. One about Nikki Haley's debt, and the other piece about going to CDs during market volatility. But first, I want to talk just for a second about Tiller, because Tiller recently won the FinTech Breakthrough Awards 2018, their best wealth management tool. And the reason is that it's all based on spreadsheets. And whether you use Google Sheets or you use Excel, Tiller works with both of them. You can try it out, by the way, for free to kick the tires. Mom uses it, though, for a completely different reason than I do. And if you're like me and you're somebody that doesn't like the complexity of spreadsheets, hold on, because the cool thing is, two cool things. Number one is the spreadsheet is its salvation because of the fact you can dumb it down and dumb it down more and dumb it down more. And the cool thing is if you go, I don't want to dumb it down, Joe, Tiller has a ton of templates, so you can choose the easiest one that you want. Me, I chose the easiest template possible, and then I dumbed it down even more. Mom, on the other hand, loves charts, love graphs. You can get all that in Tiller. And the cool thing, when it comes time to look at your budget, take a look at your investments, you hit one button and all of it safely and securely downloads from your financial institutions. One press of the button. Try it out, stackingbenjamins.com/Tiller for more. I'm a big fan of Tiller. It was cool to see how many people at FinCon, where I just recently was in Orlando, that are fans. When you've got the financial nerds all talking about how Tiller's their favorite tool, you know you're onto a pretty good thing. But really, really fun product, Tiller. All right. Let's talk about these two pieces, shall we? And pull them together. Our first piece we talked about was stock market volatility. And we went into the stock market all over the place. And a lot of people may be turning to CDs, and CDs can sometimes be compelling. But our takeaway is that risk come in many flavors. And before you move from one investment to another, take a look at the risk with CDs. Because the risk is that you're just going to keep up with inflation. It's going to be difficult to beat inflation in CDs. You're going to probably have to move back into a long-term investment. CD is not a great long-term investment, just like stocks are a horrible short-term investment. Then we went to Nikki Haley's debt, which is in the spotlight lately. She's got some credit card debt, apparently, according to this piece. She has she has a home equity loan, big, huge mortgage, and we talked about debt being a chain somebody else can pull, and that at some point you got to make up for all this debt you got into. You got to come back and work through it. I think that the big point here, guys, the big takeaway for me, looking at these two and how we combine them into this big idea, is a lesson I learned a long time ago, which is this. Everybody looks at the first domino. The stock market's going down on one end. On the other end, hey, I got this thing I want to buy. I don't have any cash. I take out debt to pay for that thing that I can't afford today. Or the stock market's going down. I'm going to move to a CD, going to move to a money market, going to move to a bond. We don't think about, and this was the big concept that was taught to me when I started learning how to make money in the markets. Look at the second domino. What's the next thing? Because if you only look at that first domino, you're not seeing the full picture. If the first domino is stock market's going down and I jump into CDs, the second domino is, wait a minute, I'm going to have to get back into a long-term investment, or I'm going to have to save dollar for dollar toward my goal because the CD is only going to keep up with inflation. Different whole set of factors when you look at the second domino. When it comes to debt, if I use debt today, second domino is I got to pay that debt back, and at what interest rate? And by the way, not even the interest rate. What's the opportunity cost? What are the decisions I'm going to have to make in the future that I wouldn't want to make, that I'm just going to make to pay this stuff off? Like, I'm going to have to take time and energy that I'm sacrificing today to get that back tomorrow. Look at the second domino. When I started realizing this idea of the collateral damage that happens when you make a decision, everything changed for me, and I think it'll also change for you. Hey, thanks a lot for hanging out, everybody, on Facebook today. Thanks also for everybody who listens at home. By the way, if you could do me a favor, a little favor, we are stuck at an odd number with reviews at Money in the Morning. Show hasn't been around that long, but we have 13 reviews. And if you know anything about luck and lucky numbers, we've been stuck at 13 reviews for a while. So if somebody could write one review, I'd be much happier at 14 than this is not an unlucky show, kids. This is a very lucky show. And I'm lucky that you're here with us. We'll see you next time back here at Money in the Morning.
Money in the Morning is created by Joe Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only, and you shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor and second, having your head examined. Have a headline you'd like us to discuss? Send them to Joe at stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.